All right, Eric, Rafael, how are you?
Doing well.
Wonderful.
Thanks.
Thank you for being here. We have our participants that are coming in. I'm going to go ahead and give it about 30 seconds or so to allow the rest of our participants to come into our room here. And so, again, thank you for your time. It's great seeing you guys.
You as well.
Yeah. All right, everyone. Well, we'll go ahead and get started. My name is Gary Martinez, commercial real estate broker with Asheville Associates, and your immediate past president for SoCal CCIM. Want to welcome everyone to our Lunch and Learn, having to do with the economic forecast in commercial sectors. We're very excited to have this presentation for everyone today, and very excited for our presenters as well. So, before I get to our presenters, we want to go ahead and do a little housekeeping. Just want to remind everyone what the mission statement is of CCIM, which is the mission of CCIM Institute is to elevate our members to the highest levels of success in the commercial real estate profession. And that's exactly what we try to do as we are putting together these webinars. Also want to encourage everyone to follow us on the social media sites. We have Instagram, Facebook, Twitter, along with our YouTube channel. And if anyone's looking for a recording of this, we're going to have it there in the YouTube channel as well. And so we have a nice library there, and we encourage everyone to subscribe and follow us. We have a lot of good content that we're really trying to pump out for our members in the commercial real estate industry. Also want to give notice, you'll see some new names there to our SoCal CCIM chapter 2021 board of directors. These are our new officers that have been put up their hand and said that they are going to, partake and do everything they got to do. And actually, what we're going to do right now is we're going to do a little inauguration and just swear them in. So I'm going to go ahead and look for our directors. I'm going to bring them in and turn their videos on. And so we could go ahead and do that. And I'm going to stop sharing the screen in the meantime. So. And there we see Eric there. Eric's our new incoming president. Eric, thank you so much for all your hard work and for everything that you do.
Thank you.
All right. So if you would, just give me a sec here. I'm going to start bringing some folks in. All right. Let's see all these good-looking faces here. All right. So, board of directors, thank you. Thank you for being here. We're very excited to have you partake into our SoCal CCIM chapter. I know a lot of you have been with our organization for quite some time, and I really want to thank you for everything that you've done for our organization, because there's no way we could do the things that we do without your assistance and with your help. And so just want to give some information to our participants that are on here. I can just give some information as to how we've been performing as a chapter. So as of 2020, our chapter had 131 members with 65 designees, 43 candidates, 23 trade associations or associates, and we had 9 newly pinned designees in 2020. We had a record setting of sponsors. I think our sponsorship level was as high as we've ever seen it within our chapter. And we were having some really wonderful support from our sponsors, and really want to thank each of them for everything that they do. And we definitely want to support them as much as they've been supporting us as well. Last year, and we all know we had a trying time, and it was a very different, unique year. And so, but what we did, very quickly is we switched everything to a virtual format. And in a virtual format, what we had is we had over 1,000 attendees attend our virtual programs. We led the way of our Region 2 and actually the CCIM Institute as to how we were doing things and the things that we're doing. We became a model for a lot of the chapters that are out there. And so and our leadership, that's been involved. Again, there's no way we can do the things that we've been doing without the leadership that we've had in place, for the previous years and this year. And another thing we did last year is we have a really strong push with our university outreach program, specifically with Cal State Fullerton. And so with that, want to go ahead and introduce our new sponsors, or I'm sorry, our new board of directors. We have William Hugren here. We have Dino Champagne. We have Justin Hugren. And we have a couple of others that should be joining us shortly as well. And so what I'd like to do is just read out loud, okay? I'm gonna ask this question to our new board of directors, and let them know our responsibility. So, election to a position of leadership in any organization is an honor not to be taken lightly. Your fellow members in electing you to your respective offices have expressed confidence in your dedication and ability. As chapter officers in SoCal CCIM chapter, you will represent to your fellow designees and candidates the highest standards of our worthy profession. I'll ask you a question. Do you understand and accept the responsibilities and duties of the office you are about to undertake? And do you pledge to uphold the bylaws of the SoCal CCIM chapter? And you can answer by saying, I do.
I do.
I do.
I do. All right, well, wonderful. And that's what we have. And so you are hereby installed as officers of our SoCal CCIM chapter for 2021. I want to thank you so much. And, we greatly appreciate all the help and support you've been giving, because there's no way we were able to do the things that we're able to do without each of you and everyone else as part of the board of directors. So thank you so much for your time. A big thank you to Eric Frickle, is coming into our 2021 president of our SoCal CCIM chapter. We're all here to support you and offer as much guidance as we can as well. So Eric, Willie, Dino, Justin, thank you so much for all your help and everything you do, for stepping up.
Thanks, Gary. It's
Thank you,
an honor
Gary.
to hold this position. I'd like to thank the board of directors for placing their trust in me with their nomination, and our chapter members for the vote of confidence. I'd also like to thank Gene Trowbridge for establishing our chapter 37 years ago, our members for participating in these events, and our sponsors for making them possible. Lastly, Gary, I'd like to thank you for doing such an outstanding job as president and getting our chapter through a difficult year last year. In fact, you're so good at hosting these events on Zoom that we're going to be seeing a lot more of you, because you're much better at this than I'll ever hope to be. But despite the challenges of having to meet online, I'm really excited about our future. We're working on new ways to promote our designees and assist candidates in achieving their designation and providing some interesting educational content. Like most of you, I'm looking forward to when we can get back to meeting in person, because the chapter's strength is in its networking. We still have a few opportunities for members that would like to be on a committee position this year, and we always welcome your input on how we can help our members and sponsors. So please feel free to reach out to me at 951-817-5200 or Eric Frickle at ccim.net. And with that, I'd like to turn it back over to Gary to introduce our sponsors and our presenters today.
Yeah, also what I want to do is remind everyone at the beginning of the year, we do have membership opportunities. And so in the chat box, what I did is I just put up a link. So if you're interested to become a member of SoCal CCIM, or you're looking to renew, that web link that I just shared with you should be able to take you to where you need to go in order to become a member and participate in. And again, like Eric said, we're always looking for help and support. And so there's opportunities for some leadership roles. With that, want to introduce each of our sponsors as well: Allied Commercial Real Estate, Asheville Associates, Asset Preservation, Baker Law Group, and Syntax, along with Platinum Wealth Group. And so just want to thank all of our sponsors and want to recognize them, and just want to let everyone know as well, if anyone's looking for any type of resource, or if you have any questions, all our sponsors are open for business and would love to hear from you. And so if you have any questions, don't hesitate to go ahead and give them a call. They're here to support us, they're here to support you, and they would love to hear from you. And so with that, again, sponsors, thank you so much for your time and for everything you do. we definitely want to support you as much as you're supporting us. So thank you to our sponsors. So with that, let's go ahead and get into our program. We have in the beginning of the years, we've been having Katerina and CoStar coming in and talking a little bit more about what's happening in the marketplace. It's a very interesting time, and it's something that all of us are trying to grab a hold of. And overall, the better educated that we are, the better we're going to be for our clients as well. And so we wanted to bring in Katerina along with Rafael, talk us a little bit more of what's happening in the marketplace. They do a wonderful job with their content. And I can't think of any other group that would be more appropriate and better for us for our program here. So with that, Katerina, Rafael, I'm going to stop sharing the screen. The floor is yours. Again, thank you for your time.
Yes, thank you so much for everyone having me back again and inviting my colleague Rafael along with me. He will be covering the Inland Empire. Is Kim on the call? I know Kim often likes to.
If he is, I'll bring him in.
Let's see if we can bring Kim in really quick.
Yes, there it is. You're muted, Kim.
Oh, there we go. Can you hear me?
Hear you, loud and clear.
Perfect. Yeah, I just want to thank you guys for inviting us to present to you guys again. I know it was well received last year, so we're excited to present to you and then bring on Rafael as well, because I know we've had a little bit of a lot of people are asking about Inland Empire data, so I'm glad he was able to join us as well. So Katerina and Rafael are going to be going over a lot of the market and economic data today. Just wanted to remind everybody that a lot of the information that you see today is available in the CoStar product. So if there's any interest in getting access, or you just want to see what options are available to you, if you were to sign up for CoStar, feel free to reach out to me. I'll put my information in the chat. Otherwise, thank you, CCIM, for having us again. And thank you, Katerina and Rafael, for presenting today.
Kim, thank you for all your help and support. You've been a wonderful supporter for our organization. So really want to thank you. Thank you so much.
Yep.
All right, Katerina, Rafael, it's all yours.
Perfect. Well, we'll start off. I'm gonna be honest, we're gonna be going kind of quick through the information because we have a ton to go over today, and also we want to make sure we get through all the information as well as in Inland Empire as well. If you would like a copy of the slides, please feel free to reach out to myself, Rafael, or Kim. We will make sure you guys get a copy of the slides if you want them. Otherwise, I'm just going to hop right in and start talking about Orange County. So let's share my screen. Want to make sure everyone can see my screen now.
Yep, looks good.
Perfect. Okay, so speaking on Orange County, we're just going to do a quick overview of basically the year gone by. I always start with the economy. If you've joined us, it's always good to have a quick look at the economy. Then we'll hit multifamily, office, industrial, retail, and then wrap things up with investment. If you have questions, feel free to throw them in the chat. We probably won't get to them to the end. I do want to make sure that there's enough time for all the content, but I definitely will be reading them and we'll maybe answering them after we're done speaking. So let's hop into the economy. Looking at Orange County's unemployment rate, it has continued to come down after those peaks hit in mid-March, of course. It is now at 6.4%, right in line with the national average for the first time since the start of the pandemic. So that's good news there. And it's still trending below the California state average, of course. So heading in the right direction. These numbers are as of the end of November. We have yet to get the December numbers, so it should be coming out soon. So these numbers will be updated. However, just due to the national news and the national numbers we are seeing, we're likely going to see kind of some ticking back up after we go through this. So when we're looking at total non-farm job growth year over year, November ended at losses of 7.6%. While that is expected, obviously we're well down from the previous year levels. Again, this is on a much better pace than where we had been previously. You can see we've kind of been ticking back up. Leisure and hospitality continues to be the largest decrease of any sector around the county, with the continued closures of most of our tourist attractions in the county, as well as Disney announcing permanent layoffs at this point. That's going to continue to be that way. And until there is any sort of openings or plans to even opening, it will likely continue down in the next couple of quarters, that's going to be hit particularly hard, and we're not going to see those jobs coming back quite yet. We've seen some return back. A lot of the retail industry has started to return back, but not quite to the numbers we had been seeing previously. So while Orange County had been heading on a good path as of the end of November, again, the national numbers of December seems to lead us to believe that it's going to be a slightly temporary trend back down until the new year starts again, and we hopefully see some better numbers. CoStar doesn't forecast the economy. We use Oxford Economics for it. Kind of want to provide that there are different economic scenarios available. I believe I referred to them a little bit in the presentation, but just kind of want to tell you when I talk about the forecast, the economy we're basing that on is the Oxford Economics baseline forecast. That's that gray line there. So you see that's kind of the sharp recovery in 2021, but we're really not getting back to those previous levels, those nominal levels pre-pandemic until really late 2021 to early 2022. So let's hop into the multifamily market. Apartment supply, demand, and vacancy in the last year. As you can see, vacancy is actually elevated in Orange County before even the pandemic started, just due to the large amount of inventory we had deliver at the beginning of the year, which of course then when everything shut down, they didn't lease up at the rates that they had been previously expected to do so. So we really did see vacancies rise quite a bit in the first quarter, first 2 quarters really. But as you can see, really strong leasing in the third quarter brought those vacancy rates back down, back below 5%. And that really was due to the very strong leasing in the third quarter. It seems to be basically, it was a delayed leasing season. Normally what we would have seen in the spring and summer months, we instead saw in the fall as people were starting to realize that they needed either a new place, so a bigger space, or people who might have left temporarily during the start of the pandemic starting to come back to the area, even though they were still working from home. And we have a couple of projects still set to deliver in the next couple of quarters in particular. Some of the largest projects I wanted to highlight is Avalon Brea Place up in Brea, Broadstone Archive in Santa Ana, and the Aura Apartments in Orange. I think the really interesting thing about these units and the units that are currently under construction is where they're located. So in the last decade, we'd really seen a primarily almost all the units coming into Irvine, and any units that were outside of Irvine were being delivered in the Platinum Triangle in Anaheim. That really shifted in the last year or so. In fact, we actually have Central OC east of I-5, which is a good chunk of Santa Ana, has a majority of the units under construction in the county right now, and North County right behind it. So we've really seen a shift of where developers were focusing on. The good news is the hope that these units will kind of not cannibalize the same renters, as kind of was the issue we were seeing sometimes in Irvine, that the slower lease up was due to a bunch of new properties competing for the same set of renters. With them spread out around the county, they might be able to kind of reach different renter pools around the county. So hopefully help those lease ups in those units as they deliver. And so mitigate some of those maybe quick vacancy rises when they deliver on time. Looking forward, with all these new units delivering in the next couple of quarters, as I said, we do expect vacancies to rise temporarily while that happens, and stay elevated in the long term, for the short term, I should say, just because while we do expect them to lease up at a relatively steady pace, as we've been seeing units as of late, especially all the new units that came in 2020, definitely we're leasing closer to 20 units a month by the end of the year, as opposed to the 10 units a month they were experiencing in the first quarter or two. That's still, with the amount of units coming on, we do expect those elevated vacancies to kind of remain in the county for a little bit, but then come back down in the longer term when things return. And while it's not on this graph, it is also important to note that the elevated vacancy rate isn't expected to hit where it was even at the beginning of 2020, but especially not where it was in the Great Recession. So we seem to have mostly flattened out since that point. But I think the interesting trends that really came out from multifamily was in the rents of multifamily, of course. So looking at an index, basically indexing rents to 100 at the start of January 2020, and seeing where daily rent levels went from there. This is comparing the national versus Orange County. National is that gray line, Orange County is the green line. And as you can see, Orange County was hit particularly hard in March and April. We saw some of the most significant rent losses of anywhere in the country at the time. However, once bottoming out in June, once the stay-at-home orders, the initial stay-at-home order, I should say, ended, rents began climbing back up. And so while the rest of the country on average experienced that typical seasonality and saw rents come back down in the winter months, that didn't really happen in Orange County. We saw rents continue to rise through the fall, even into the early fourth quarter, and started flattened out at the end of the fourth quarter. But as you can see, rental rates on average are now back above where they were at the start of 2020, and right around that same peak that was hit right before the start of the downturn. So a really positive growth that while there were some significant losses during the middle of the year, once that leasing picked back up, once things kind of increased again, we saw those rental rates come back up as well. And that's kind of the trend we were seeing through most of the submarkets around the county as well. Irvine being one of the biggest exceptions to that rule. The year ended at almost -1%. Again, that's just due, I think, to the large amount of inventory that had delivered in the last couple of years, and the competition there. They weren't really able to recover as well versus some of the other submarkets around the county, in particular those coastal submarkets. So South County, Huntington Beach, and Newport Beach, they actually saw some of the larger losses during that initial drop in rents. Newport Beach in particular saw losses of almost 6% during until basically June. We saw losses from March until June of almost 6%. That has since flipped, of course, and now Newport Beach is actually already year over year in the start of January at about 1% growth. They did end the year a little less than 0.5%. But again, it really was a reversal of coming back up and seeing some really strong growth in the second half of the year, as I think renters were not only looking for larger units, was definitely a trend we were seeing across the board, mostly because if you're going to stay home, you need a little bit more space, but also because people were looking for those outdoor amenities that maybe were nice before, but not necessarily a top priority. And so people were going to take advantage of those lower rents by the beach to live by the beach, since outdoor seems to be the way to go right now. The last thing I wanted to mention in multifamily was taking a look at those concession rates across the county. Again, unsurprisingly, when we saw those rental rates drop, when we saw the leasing decrease significantly over the summer, we did see the number of properties offering concessions increase over the summer. In July was at peak at about 26% of the units in the county were offering some sort of concession. While that did come down during that fall leasing that we ended up seeing, they have ticked up in the winter months again with the slower winter seasons. Typically, we do often see them a little bit higher than normal, but as you can see, November versus December of 2019 versus 2020, they are still quite a bit higher. So about 1 in 4 properties were offering some sort of concession at the end of 2020. The good news about those concessions, though, is they are down from where they had been. Earlier in the pandemic, we were seeing, especially those newest properties, offering up to 6 to 8 weeks free rent, or sometimes even 12 weeks free rent on some of those newest communities on select units. That's really come down in the last couple of months. And so we were seeing concessions much closer to the 4 to 6 weeks of free rent, and even lower in other places. So while more properties might be offering concessions than they were in the fall, they're not offering as high a concession as they had been during the summer. So not all bad news there. So the big picture on the multifamily market is that while it was hit particularly hard at the start of the pandemic, it has really recovered since, and is in a much better place going into the new year. Office, on the other hand, is kind of a different story. When we're looking at office leasing, it's down significantly, of course, from where we were seeing in previous years. So if you look at 2020 leasing versus 2019 leasing, it's well below any of those historical levels. It's well below 2019 levels. Just didn't see a ton of activity in the county going on. Much smaller deals on average were occurring as well. What this has meant is that we have seen some vacancies market, more and more companies either putting space back on the market in sublease, which I'll talk about in a moment, or just vacating spaces in general. And so we've really seen that vacancy rate increase significantly in the last 2 quarters. So while it stayed relatively stable in that first quarter and first half of the year, really, it has there's been a significant uptick through the end of the year in our office inventory. And we see vacancies increase significantly as we've seen a lot of vacant space hit the market. A lot of that vacancy, as I said, is sublet space. When we're looking at the amount of sublet space on the market, again, a key indicator of how healthy the market is, you can see it's up pretty significantly from those 2019 levels. And really a majority of that space, again, came in the second half of the year. We saw large companies putting up space. A lot of companies, I shouldn't say large companies, a lot of companies were putting up space during the time period and really saw that significant uptick in the amount of sublease space available in the market. However, that has offered some opportunities for companies in the area. Some of the largest leases in the year, really, but really in the second half of the year, were for sublease space. For example, in the fourth quarter, two of the largest leases were SEW Eurodrive leased 40,400 square feet off of Sand Canyon Avenue. They signed that lease in December with a planned May move-in. And then Mission Loans signed 30,000 square feet off of Jamboree Road, also signed in December with a May move-in. So these are two spaces that were available and people taking advantage of that sublease space, often those lower rents than they would normally be seeing in those kind of really prime areas for real estate. So companies taking advantage of those lower sublease rents that they might not have been able to be in the area before. The Mission Loan space in particular was vacated just in the summer of this year and already got released. Again, just that prime real estate was able to company was able to take advantage of that really great space for a lower rate than they might have been able to achieve in previous years. So that does leave some opportunities moving forward. There's still competition for new space, of course, in the Irvine area, because that's still where we're seeing a majority of the new construction in Orange County. Some of the largest projects are down in Irvine Spectrum. So you have the Spectrum Terrace is just starting to complete their second phase. I believe one of the three buildings has delivered thus far, the building that will be housing TGS management. They had pre-leased the space before they broke ground. And I believe the other two buildings should be following shortly in that project. I don't know the official plans on the third phase of the Spectrum Terrace, but as of now, they are still planning on moving forward on that space. The other large project, of course, down in the Irvine Spectrum area is Innovation Park. That is going to be 550,000 square feet. And my audio is getting fake. Sorry, I'm seeing this. Okay, I'm going to try to speak louder. I don't have a microphone on this computer without the headphones, so I'm going to try to speak a bit louder. If we keep having problems, I will switch to my phone and be able to call in. So let me know if there's still some.
That sounds better, Katerina, by the way.
Okay. I'll just hold this up to my face then. Technology is great. Sorry about that, everybody. So we have Innovation Park also set to deliver early this year. That's going to be 550,000 square feet. And as of yet, they haven't announced any large tenants for that space. So there'll be a lot of new space coming onto the market at the start of the year for more competition in the Irvine and Irvine Spectrum areas. So of course, looking forward into the forecast with a bunch of new spec space expected to hit the market in this first quarter, we do expect those vacancies to continue to rise. We expect them to, again, go above 12%. So the first time we're seeing those numbers really since 2012. But again, there's been some stability in the market as much as, there's concerns around the office market, and we definitely want to keep watching. And I think that's an opportunity for if the sublease, more and more sublease space hits the market, we could see a potential soften even further. But even in our forecast thus far, we don't expect vacancies to get anywhere near those great recession levels. And I think that really has to do with the diversified tenant base that we're having in Orange County now versus the mortgage heavy tenant base that Orange County had going into a recession that really hit the mortgage industry in particular. So while it is definitely in a much rougher space than we were at the beginning of 2020, it definitely has had a little bit more stability than we probably had in previous years. So it's something that we will keep observing, but hopefully not all bad news. Looking forward and looking at that rent growth and what it did, of course, in reaction to the rising vacancies, the amount of space coming out of the market. The year did end with rent losses on average. We saw losses of about 1.7% year over year at the end of the year. The national average was negative as well, but Orange County did just outpace it slightly. And that's just, again, expected with the amount of the rise in the vacancy rates as well as the amount of space coming onto the market, that there were going to be rent losses. And we do expect that to continue at least in the near term. However, it's not that all areas of Orange County experienced such rent losses. We're looking at the breakdown by submarket. The submarkets that had the largest rent losses were some of those most expensive submarkets, such as Irvine, Newport Beach, Laguna Hills. These are the really expensive areas that couldn't afford basically to keep those expensive rents necessarily if they still wanted to attract tenants, as well as the competition dealing with new inventory coming onto the market versus some of those more affordable areas over there on the left. We have Westminster and Tustin. These areas actually still saw positive rent growth by the end of the year, well below those levels that they historically would have experienced, but definitely more stable, obviously, as they provide an affordable option for companies that are still in the area, that are still looking to lease space in the area. They're providing that more affordable option, which is why their actually rent did continue to grow in 2020. So again, it kind of really depended on where you were looking in Orange County, though on average, we did see rents drop. So going back from some not great news to back to better news, or kind of flipping back and forth here, looking at the industrial market in Orange County. Now, the industrial market had a really steady year, all things considered. When we're looking at the leasing, annual leasing in Orange County, while it is below those 2019 levels, it was just in line with that 10-year average of leasing. So we still had quite a bit of leasing, mostly within the warehouse segment. The warehouse segment in particular really saw no significant drops in deal flow or the amount of square footage leased in 2020 versus previous years. So that was the segment that really supported this. But the other thing in particular was we saw a lot of industrial companies expanding in 2020. Some of the largest leases were for expansion. So for example, Brentwood Home leased 222,000 square feet of manufacturing space in Fullerton. The company already occupied 156,000 square feet in Fullerton. In La Palma, we saw an apparel company, I'm going to probably say this wrong, Americi. They leased about 170,000 square feet. In La Palma, they're expanding, actually they're based in LA normally, and they're expanding from that headquarters in LA to this space, and will actually be moving some of their office employees to this space as well. And the other large expansion that we were seeing in Orange County, Inari Medical leased 120,000 square feet in Oak Canyon 2 Business Park. They signed a 10-year lease, and this is again an expansion that quadruples their footprint in Irvine alone. So we actually did see a lot of expansions in particular in the industrial segment, which really helped propel the strength of the industrial segment. What that has meant for our supply, demand, and vacancy is that vacancies have remained relatively stable. They did go up a little bit during the year, but they're right about in line with where we ended 2019, and the strong leasing helped propel that. The other thing that, of course, has helped keep vacancies stable throughout Orange County is the lack of new inventory coming in, as well as the demolition of old inventory. So since 2015, these are the properties that have been demolished, the industrial properties, I should say, that have been demolished in Orange County. We've been averaging about 1 million square feet of office or of industrial space demolished per year. So we've just seen a significant loss of inventory, which has helped keep the spaces that are on the market filled and kept vacancies and fundamentals relatively stable. Some of those notable projects, though they were demolishing old warehouses or old industrial buildings, they are actually being built into new industrial buildings. For example, of course, we have the Edwards Life Science building their R&D facility at the former Royal Carpets warehouse over off of Red Hill Avenue. The recently completed Briggs Corporate Center, it converted 62,000 square feet of warehouse space into 52,000 square feet of manufacturing space. And another one that might be coming down the line is the Kimberly Clark facility in Fullerton. It's 1.1 million square feet right now, and there are currently plans to demolish that facility and build a 1.5 million square foot warehouse, more modern warehouse in its place. So we actually will see some expansion of industrial inventory on those old footprints, but it does take the getting rid of the old footprint first. So what does that mean overall when we're looking forward, of course, is we really do expect those vacancies to remain stable and actually compress in the near term as we see the leasing increase, and we see, again, the prominence of the industrial scene in Orange County has continued to grow, and more interest has come for the properties that are available in Orange County are normally quickly leased. So we're seeing really healthy market as we move forward. Still, it was an economic downturn, so we did still see rents continue to slow. While they absolutely remain positive and some of the strongest of anywhere of any property type in Orange County, they did slow from where those previous levels and ended the year right around 2.2% growth, or 2% growth. I'm sorry. In particular, again, the warehouse segment actually saw some. The logistics in particular saw some of the strongest rent growth overall of all of those segments of industrial. The other areas we saw strength, of course, were in certain submarkets like Buena Park and La Palma and Fullerton. These were the submarkets that saw some of the strongest leasing in the last year, and especially again in the logistics segment. So they saw strong rent growth follow that up, as well as again, the concentration of logistics space up there means that it is lower rents in general in that area, which helps kind of give a little bit more room for movement on those rent growths. On the other end of things, the more expensive submarkets such as Laguna Hills and Costa Mesa continue to post some of the lowest rent growth, but they have a high concentration of flex and R&D space, which average much higher rents. And they just historically have seen much more modest rent growth in the county in general. So these were just basically continuing the trends that we had been seeing previously, just at maybe a little bit of a lower level than we had been seeing. So overall, a really, really healthy industrial market, really stable industrial market in this past year of kind of craziness. A big factor, of course, being e-commerce. And I'll talk about that in a little bit as well. Lastly, to wrap up the last of our property types, looking at a quick look at retail back into the not so great picture, unfortunately. So when we're looking at the retail market, we did see vacancies continue to rise throughout the year as we saw the closure of stores, both for planned closures, such as Forever 21 and Dick's Sporting Goods, as well as national brands like Macy's, but also just the smaller stores and the unable to maintain the stores during the shutdowns when stores weren't even allowed to have customers in. We did see vacancies, of course, rise, and we saw a lot of vacancies hit the market. This was actually the steepest climb in vacancies since 2009, I believe it was, when the last time we saw the vacancies rise this quickly in this market. Again, to be expected with all these circumstances really around retail was very much restricted by state mandates, state and local mandates. The retail experience was really dictated by those. Unsurprisingly, retail leasing was also well below those previous year numbers. So not only was leasing down, but the leases that did happen were on a much smaller scale than we typically were seeing. On average, for the past 5 years, leases were around 3,000 square feet. On average, now in 2020, they were only about 2,200 square feet. So quite a bit smaller in general. Grocers were some of the largest leases that were signed during the year. Amazon Fresh started the year with 40,000 square feet that they ended up, they signed in, I believe, February, and then opened the store in October. And then we had a Sprouts Farmers Market is going to be leasing 24,000 square feet up in Garden Grove. The project is currently a vacated Vons that they will be demolishing and building a smaller shopping center in its place with the new Sprouts as their new anchor. So there is some movement, but again, some of the largest leases were for those essential retailers who have been able to stay open and stay active during the pandemic. Looking at construction, there still isn't, of course, a lot of construction in retail. There hasn't been in years, and that's obviously going to be a trend we expect to continue. The two largest projects continue to be the Press's Market Hall, as well as First Harbor Plaza. Both these projects were supposed to be completing in 2020, but as they're both heavily reliant on their office components, they've both been delayed into 2021. So they have not opened yet. I don't know when. I believe they're planned on later summer openings now of 2021, but they really are reliant on when the office component starts opening. That's when they likely will be opening their retail components as well. So looking forward, of course, we do expect retail vacancies to continue to rise in the near term again, as more and more social stores close. When we're looking at those commerce numbers and we're seeing the spending across the nation was down in December from what we expected, I think a lot of stores were trying to make it through the holiday season and see if they could survive on those holiday funds. It's looking like that's not the case, unfortunately. So we will be unfortunately seeing a lot more closures, I think, in the new year, which is why we expect those vacancies to continue to rise until things kind of start calming down and we have the market opening back up, not just for regular retail, but of course bringing tourism back to Orange County, which is a huge factor in the retail in Orange County. So all of this, of course, has meant that rents did drop in 2020. We saw losses of about 2% year over year. In particular, we saw that general retail, so those smaller retail centers, hardest with losses of about 2.2% versus for the power centers and neighborhood centers that again have those essential retailers at the anchors. While they still saw some losses, they weren't quite at that same level as we were seeing in general retail. And lastly, of course, we did see losses across the board in every submarket as well. The most expensive submarket, or the submarkets that saw the largest losses were actually some of the submarkets that had seen the largest gains in the past 5 years. So for example, South Santa Ana had been averaging about 4% rent growth from 2015 until the end of 2019. And of course, 2020, they saw losses of almost 4%. Cypress also averaged annual rent growth of about 3.5% from 2015 until 2019. then saw those losses about 3.2%. So it's almost the market leveling itself off, because on the other end, when you're looking at the city area and Irvine spectrum, these are the submarkets that typically saw some of the most modest growth in the last 5 years. While there was absolutely growth, it was much more modest. And they saw some of the most modest losses as well. So it just seemed to be a leveling the playing field almost in or across the submarkets in Orange County. So to wrap up Orange County, I just want to do a quick look at investment. Unsurprisingly, investment was down in 2020 from those 2019 levels across the board. We had some sales. We did see investment pick up in the fourth quarter in pretty much all property types, but just well below those previous levels. Looking more specifically at multifamily, again, really strong fourth quarter, but still it's deal flow was well below. So the number of deals we saw was well below those previous year levels, and volume was well below. We really saw that pushed up at the end of the year with a couple of very large sales that did occur that pushed kind of that volume at the end of the year. But the sales that occurred did show pricing growth. So we actually saw prices continue to rise in 2020 in multifamily. While they had really stayed level through the first part of the year, where people were very unsure about basically where the vacancies are at, where the rent growth return and all of that, it picked up again at the end of the year. Office prices, on the other hand, stayed mostly level. We just didn't see really growth, but we didn't see losses in those areas either. We saw a couple of large sales in the third quarter in particular. We saw some of our largest sales, but the other trend we were seeing is there was a lot of office medical space that sold. That would seem to be the largest trend. And in office medical space, we actually did see a price increase across the board, but overall office prices stayed mostly stable in 2020. Industrial, of course, did see prices continue to rise as well in 2020, despite the fact that volume was well below those previous levels. Again, it's about 75% of the annual average of the last 5 years, and deal flow was well below that as well. So there's only about 375 trades that took place in 2020 versus the average of about 670 every year. However, again, we did see some large deals occur at the end of the year. The most notable ones I want to put is 515 East Dyer Road, sold in December for $113.6 million. And then also we had the former Mitsubishi headquarters campus, or North American headquarters, also sold at the end of the year for $73.4 million. Both these deals, of kind of what I said before, had Amazon as the tenant in the spaces. So at 515, they are already the tenant, and they are the future tenant for the former Mitsubishi campus. So e-commerce, again, really pushing the expansion in Orange County, as well as the strength of the industrial picture. And lastly, the quick look at retail sales. Really, the retail volume was comparable to previous years, only because of the really strong first quarter. It was actually the strongest first quarter we had seen in over a decade. However, the number of trades was down significantly by the end of the year, of course, and we weren't seeing nearly as many trades of the same quality by the end of the year. And again, the same trend as with the leasing in those sales was that the trades that did occur at the end of the year were really for those essential retailers. So the largest trades had either a Home Depot or grocer as a part of them. So again, the trend now in retail seems to be focusing on those essential retailers. I know I went over a ton of information. Again, if you would like a copy of the slides, please feel free to reach out to myself, Kim, or Rafael. But in that case, I do want to throw it over to Rafael so we can talk a little bit about the Inland Empire. Stop sharing the screen. There we go.
Thank you, Katerina. Can you confirm that you can see my screen?
Looks good.
I can see your screen.
Yep, great. So pretty exciting stuff that we're seeing in the Inland Empire. It really is, market of extremes. When we talk about the different property types, you have really hot multifamily and industrial markets. Retail markets, meanwhile, are suffering some of the same trends that we're seeing in Orange County and really throughout the nation. Office is a little bit quieter, and I'll wrap up the presentation with a few slides on capital markets to kind of show you what's going on and how that translates to the investment side. Now, in terms of the economy, we had pretty severe job losses in the Inland Empire, just like we had just about anywhere in the nation. Jobs fell by about 200,000 from February to April. That's a 13% decline. We recovered 122,000 jobs by November, which translates to about a 5.4% decline, still pretty severe relative to any recent recession in terms of how many jobs we've lost. Looking at the forecast, which as Katerina mentioned is driving a lot of our real estate forecast, we have jobs returning to sort of recovering all the 2020 losses by the third quarter of 2022. So it's going to be a little bit of a slow recovery if Oxford's right. This is one of the inputs that we're using into our model. So any forecast that you see for vacancies or for rents pricing, this is one of the main inputs that's really kind of that's driving our trends. Now, thinking more long-term, because these are all cyclical factors, I always like to talk about the population growth in the Inland Empire because it's really a huge story. When you look at population growth over the last 10 years or so, we're looking at growth rates between 0.7 and 1% on an annual basis, which is above the national average and above most of coastal Southern California. But it's just not the same growth that we had in prior decades. In the 80s, 70s, 90s, we were looking at growth rates of about 3 to 4% per year in a given year. And that really changes the dynamic of the Inland Empire's economy. Whereas in previous years, there was a lot more reliance on real estate services. Construction was one of the big jobs because there's so much development going on. Retail trade, everybody's moving in, has to buy goods. Now it's changed a little bit, right? And the Inland Empire has had to adapt. One of the sort of developments that has occurred, it's really started more than 10 years ago, is growth in the logistics sector with proximity to the ports in LA, the Ontario International Airport, moving goods, lots of rail infrastructure. We've seen a ton of growth in the logistics sector, and the Inland Empire has really become a national logistics hub. What we've seen really since the pandemic is a little bit more of an exacerbation of those trends in recent months, but really a lot of the trends that you'll see were really materializing, for more than a decade. So we'll start with the multifamily market. And, as we started 2020, we had a pretty healthy supply pipeline. Vacancies were starting to rise a little bit as some of these properties were stabilizing. If you were to tell me that we were going to endure one of the, severest economic contractions that we've ever had in 2020, I would have said, okay, watch out. Vacancies are going to go up closer to 8%. But instead, we had really strong demand, pour into the market in the last 3 quarters. Really started in the second quarter, where we had we were tracking about 2,000 units leased in the second and third quarter, another 750. We ended the year with a 3.3% vacancy, which is as low as we've tracked in 20 years. So where's this demand going to? It's Southwest Riverside County, Temecula, Riverside, Corona, and San Bernardino. These 3 submarkets account for the majority of that demand that we've seen this year. The Southwest Riverside County, Temecula, this has the best proximity to San Diego. The other 2 a little bit closer to LA and Orange County. And we see that part of this is supply driven. San Bernardino doesn't look like it has a lot of supply, but that's where some of the 2019 deliveries are located. So some of that is those properties in lease up. So we've seen really strong demand in these submarkets. And when you put that into our forecast, we're seeing a pretty steady vacancy environment over the next 5 years. Overall, not a lot of construction though. There's a couple projects that are worth mentioning in Moreno Valley. There's Continental Villages, which has 252 units. In Hesperia, there's 2 pretty large construction projects, at least for that area. One with 186 units, one with 142 units, but not a whole lot of construction, not much going on at the moment in the sort of Ontario, Rancho Cucamonga area, which has seen a lot more development in recent years, but a little bit of a lull in deliveries that we expect in the next couple of years. Really the wild card here, when we talk about this strong demand, is how much of an impact the eviction moratorium is having. So NMHC suggests that nationally renters are still paying rent to a healthy level. They don't exactly report how much of their rent is being paid, and that's sort of a concern for California, where if you're affected by the pandemic, you only need to pay 25% of your rent at the time. It will be due later on, but it's that could be distorting fundamentals a little. One thing you'll see as I present is that when things look very rosy, when things look very strong, I'm always trying to play devil's advocate. And vice versa, when things don't look as great, I'm looking for opportunities and things that maybe liven up that market and see if maybe there's something else going on. So one of the areas that, I'm a little bit concerned about in terms of how strong we're tracking demand in the Inland Empire is the eviction moratorium. Let's counter that. When we look at rents, we had the strongest rent growth that we've tracked in CoStar in over 20 years. Rents grew by 7.5% in the fourth quarter. And when you see the effect, from the pandemic in the second quarter, or where rents were trending, you can see that rents were actually falling a little bit. And when we look at our daily rent series, you can see it a bit more. Rents were hardly changed from January through May, but it was after May that we started to see pretty strong growth. And we did start to see more growth for bigger apartments, units with 3 or more bedrooms, also for 2 or more bedrooms, and a little bit slower growth for studios. From a submarket perspective, again, Southwest Riverside County Temecula is really the hottest submarket in the Inland Empire. We're seeing pretty strong rent growth really throughout the Inland Empire, with the exception of Palm Springs. And the thing to consider for Palm Springs is that a lot of tenants here are working in the hospitality industry and in retail. Some of the sectors that have been hit hardest by the pandemic. Of course, tourism levels just didn't return this past summer to Palm Springs as the pandemic grew. So a little bit more of a pandemic effect here. And if you're thinking about maybe potentially anybody who's moving into the market from Los Angeles, Orange County, even from the Bay Area, who might be looking at Palm Springs as a temporary destination, typically they're not looking at apartments in this area. There just hasn't been a lot of new development in recent years. So, from that kind of perspective, single family probably had a little bit more to benefit from than the apartment market. Now, the forecast is pretty strong. And when you consider our model, how it works, it's highly correlated with employment. And in 2020, when we had a severe employment loss, we had a really high rent growth. So naturally, as the employment levels continue to recover, the forecast is going to call for even stronger growth. So a few cases for this forecast. One is the whole work from home, opportunities. People who are working in LA, Orange County, San Diego, have wages that are about 30% higher. So if we're pulling a lot of demand from those markets, which has been suggested that we are, then there's a lot more room for growth on the rent side. The case against, again, I mentioned the eviction moratorium, but also, rents are starting to hit that, we're starting to see some affordability concerns for Inland Empire residents. So one of the sort of cases against continued rent growth of this magnitude as we go forward. Now, I mentioned one of the other really hot markets for the Inland Empire is industrial. Of course, we have that growth in logistics and e-commerce, which we've really seen throughout the nation as the pandemic has since the pandemic started, and really before. 2020 was sort of a catch-up year for fundamentals in the Inland Empire's industrial market. We've had about 25 million square feet of industrial space delivered each year since 2017, but in 2020, that number fell to about 16.5 million square feet. It doesn't seem like a lot, but that, paired with really strong demand, that led vacancies fall to 3.7%, which is the lowest that we've tracked in over 20 years. Most of the activity in the industrial market is concentrated in 3 submarkets: Moreno Valley, Paris, San Bernardino, and airport area. Moreno Valley, Paris is really the most affordable submarket of this bunch. For a new building with 500,000 square feet or more, we're looking at rents of about 45 cents per month. Airport area, San Bernardino, is more of like 70 cents per month if you're looking at something in the 200,000 square foot to 500,000 square foot, which is a little bit more common in this area. It's a little bit less affordable, but still relatively affordable compared to your coastal markets. And of course, great infrastructure both in San Bernardino and the airport area. Okay. When we look at leasing volume, we are tracking pretty strong leasing this past quarter and in the third quarter. Seeing lots of demand coming really from 3PLs and logistics firms in 2020, like we have in previous years, but even more so in 2020. Just to kind of name a few of the largest leases from the fourth quarter, we had Geodice, who leased over 800,000 square feet in Redlands. US E-Logistics leased 700,000 square feet. Logistics Plus leased 566,000 square feet. And then right before the right before the end of the third quarter, we had a lease from Go Plus Logistics for 1 million square feet. We kind of saw these throughout 2020. Amazon's not included here, but they leased about 2.4 million square feet over the course of the year in 4 buildings. This has kind of been the pace that they've been growing at in the Inland Empire really for a few years. So Amazon's been a little bit more of a steady growth pattern in the Inland Empire. So the construction pipeline is getting a little bit stronger in terms of how much space is under construction. We're tracking about 21 million square feet in the Inland Empire, second most in the nation behind just Dallas-Fort Worth. Speculative development accounts for most construction. It's about 2/3, though that's pretty average compared to what we've seen in recent years. Construction is shifting more towards the airport area versus those 2 other submarkets and really anywhere else in the Inland Empire. When we look at a map of where construction is being developed, where industrial properties are being developed, strong preference to be near the 10 freeway, for example, in the Fontana area. Here we're tracking a few buildings with 100,000 to 500,000 square feet. The largest here is a little hard to see, but it's the Gray Diamond on your right. This is a Goodman building with about 500,000 square feet that was recently leased to a tenant that hasn't been disclosed yet. Goodman also built another distribution building right below it with 616,000 square feet that was leased to Amazon last year. And then there's a few other Goodman buildings on the bottom right. So you can see quite a bit of development, really want to be near that 10 freeway. One project that is pretty large, but not really near the freeways is in the New Haven Ranch area in Ontario. This here is what you're primarily looking at is the Colony Commerce Center. So these are the 9 buildings that you see here towards the right. The largest is a 1 million square foot distribution building that was leased by Restoration Hardware recently. So in these 9 properties with 1.7 million square feet, about 70% are leased, and they should be delivering in the next couple of months. Also on the top left, you see a Gray Diamond. This is a 1.2 million square foot. This is the Ontario Ranch Logistics Center, and this is leased to Uline. They're expected to move in middle of the year. So overall, strong leasing shouldn't be too much of a concern when you consider how much supply is on the way. And in the model, paired with all the strong demand that we've seen, vacancies will remain about 4% in this base case scenario. Again, we have to consider the job picture. After having so many job losses, we didn't really see a hiccup in vacancies in the Inland Empire this past year. So the model's sort of going to react in that way where the job picture is a little bit steadier as we move forward. Vacancies are going to look a little bit steadier, and there's really not much reason to doubt this forecast at this moment. In terms of rents, as I mentioned, grew by about 5.5% this past year. The forecast calls for another 5.4% next year, and then a little bit more of a rebound in 2022, if you want to call it a rebound. So another really indicator of strong demand as we go forward. Now, the retail market, I mentioned the Inland Empire is the market of extremes. And so in the Inland Empire, we actually have the highest vacancy rate among markets with more than 500,000 in population in the nation. So about 116 markets, we have the highest vacancy rate in the Inland Empire. When you look at the trend, it actually started, way before the pandemic. Although in the first quarter, before a lot of the store closures were announced, we had, quite a large amount of big box store closures coming that kind of were already had been announced. Sears, Kmart, Forever 21, JCPenney. Once the pandemic started, Nordstrom did announce 2 store closures, one in Riverside and one in Montclair. So, definitely a concern for the Inland Empire's retail market, where we have a little bit of an excess of big box space. And as we're looking at leasing volume, we haven't seen a ton of leasing. We are seeing a little bit of a decline, but as I mentioned, we saw that decline in 2019 as well. 2014 brings a little bit of optimism because we do see some leasing activity in the fourth quarter. One of the biggest leases was a former Kmart in Temecula with 86,000 square feet that lease. We don't have a tenant yet, but we should know pretty soon. And when you plug that into our forecast, vacancy rates don't rise as much as they did during the last downturn, but still a little bit more ways to go in terms of going upward. This forecast does make quite a bit of sense to me. We had to have a little bit of optimism in the fourth quarter because of the vaccine. but may still be a while before consumers are ready to return in full force as they did pre-pandemic. One of the issues that I also see, as I mentioned, is the amount of big box space that's vacant. These spaces are a little bit harder to fill at the time. There's an option to slice them up and create more spaces, but then you're really drawing demand from somewhere else, and so it makes a little bit of sense that we're going to have high vacancies in the Inland Empire for the next 5 years. The rent forecast calls for, after 2.5% growth this past year, calls for pretty much flat rents in 2021, and then just under 1% in as we go forward. About 6% as in the following year as we have a little bit of a bounce back. Again, vacancies are expected to remain high, so it's hard to really see much more growth in rents as we continue. Okay, on the office market, the Inland Empire's office market is really characterized by more construction, by very little construction, and what there is really mostly medical buildings. We have seen demand, help bring vacancy rates down, but there hasn't been a whole lot of push from tech companies or any large leases over 50,000, 100,000 square feet. So it's been a little bit of a quieter market, really pre-pandemic. For that same reason, it's probably a little bit less susceptible to the pandemic. Fewer office tenants are going to be announcing long-term work from home or permanent work from home policies. So that's a little bit less of a risk as we go forward. One thing that is a little bit, one demand driver that we have really relied on in these past years is really healthcare and education. But a lot of these, like education, like the private colleges, they have been occupying offices. Right now, those are they have shifted to virtual teaching, just like a lot of the universities. So a little bit of a concern there. Leasing volume is a little bit lower, but not a huge fall from previous years. Two of the largest leases came from medical companies. City of Hope is opening up in Corona at the middle of this year with a 32,000 square foot building. Riverside University Health System is opening up a 35,000 square foot building in Palm Springs. Those really count for your largest leases. Now, I mentioned we haven't had a lot of traditional office construction, which really made me wonder what would happen if we did have a traditional office deliver. How would demand respond to that? And so luckily we have a case study, Lakeshore Plaza Building A in Corona. This is actually in Dos Lagos near Corona. It's a 146,000 square foot office tower that was built in 2020 with 4 stories. Dos Lagos has, quite a bit of new apartments that were built in the last 5 years. Nice shopping center, golf course, an ideal sort of live, work, and play environment. This office delivered in September 2020, and it's still available for lease. Although I'm a little bit suspicious, I think we might have been tenant ready a little bit earlier in the year, but we show it delivering in September 2020. So looking for a tenant still. It'll be interesting to see who fills up this office. In terms of the forecast, as I mentioned, not a lot of risk as we move in, as we continue into 2021. Vacancies are, not expected to go anywhere near their previous peak of 16% in 2009. Again, we haven't had a lot of construction, so there's a little bit less supply risk, and some of the tenant bases, should return as the vaccine rolls out and as we start to return to normalcy. The rent forecast, though, does call for rents starting to decelerate after 4.5 year-over-year growth in 2020. Rents are forecasted to grow by less than 1% over the next year, and in the 2 to 3% range if you're looking at a 5-year horizon. Now, looking at the capital markets, really what you'll see across the property types is a little bit of hesitation in trades in the second and third quarter, but more of a bounce back in the fourth quarter. That's especially true in the apartment market. In the fourth quarter, we had a pretty big trade, which is the Crossings of Chino Hills, traded for $130 million. And this is a pretty new building, so it kind of gives you an idea of the price for a new building in Chino Hills, looking at $375,000 per unit. The buyer was Advanced Real Estate Services, and it was sold by Bridger Investment Group. This was 94.5% occupied at the time of sale. Industrial market, similar trend, really bounced back in the fourth quarter. One of the trends we saw in the Inland Empire was a higher proportion of sales were owner users. So a lot of companies who were looking to liquidate their real estate assets to raise capital. So, for example, we had DPI Specialty Foods, who's a parent company of Dairy Fresh. They sold their 258,000 square foot distribution building in Ontario in November for $65.3 million. Truist was the buyer on this one. On the retail side, we saw sales volume decline, but retail hasn't, in the Inland Empire, has never really attracted a huge amount of like institutional capital. Usually we're looking at more private buyers. So we're not looking at really at an outsized volume relative to those two other properties. Two of the largest sales were actually in Corona and their car dealerships. Spring acquired their Honda dealership in July for $18.4 million. Larry H. Miller Group acquired their Nissan dealership for $9.8 million. So kind of shows, what's trading right now in the Inland Empire. On the office side, again, looking at a bounce back in the fourth quarter, but not a lot of institutional capital here. Not a lot of investors coming in from not a lot of foreign investors or really big, companies. So a lot more private buyers. And one of the primary draws for the Inland Empire has been investment in the county or government leased buildings. For example, this building sold in October. The county of San Bernardino is a tenant. It's 38,000 square foot, just built. There's a typo there. It was built in 2020. Sold for $14.5 million or $380 per square foot at nearly a 6% cap rate. And this was acquired by Boyd Watterson Asset Management. Now, looking at pricing, we saw, when we really track back since 2007, we've seen a lot more growth in multifamily and industrial. As I mentioned, those are really the two hot property types in the Inland Empire. Just looking at the last year, multifamily grew 9.3% per our CoStar Market Price Index. Industrial grew 7.3%. Both of those are expected to average about 5.2 to 5.4% appreciation per year through 2025 in our model. Retail and office grew 1.5% this past year, while office grew 2.7%. So we're looking at more of the 1s and 2 ranges. Both of those are expected to grow at an annual rate of about 3.4 to 3.6% through 2025. So a little bit slower growth. That's just correlated to our rent projection and our vacancy projection as we go forward. So I know that was pretty quick. Thank you everyone for attending. Thank you, Eric and Gary, for having us. Katerina, is there any other thing that we missed, perhaps, or Kim?
Yeah, as I said, we both went very fast, so we apologize in advance. Please reach out to us or Kim if you would like a copy of the slides. I know I've gotten a couple people already reaching out. We are happy to provide them. Otherwise, thank you very much for having us again. I really enjoy always coming back, even in this different type of sphere, and I'm glad I could bring Rafael with me.
Thank you so much for Rafael, Katerina. Each of you do a wonderful job. And so I have a quick question. So if someone wanted to pull the information that you provided, can they go on their CoStar account and pull this information themselves?
Yeah, I would. Yeah, you absolutely can pull pretty much all of this information, if not all of it, from the product itself. If they are unsure how to do that, reach out to Kim or whoever their sales executive is, and they will show you how to do it.
Wonderful. Well, this is greatly appreciated, wonderful information. And just as a reminder, everyone, if you want to see this presentation, I know there's a lot of wonderful information, but if you want to go back and see any of it, look at our YouTube channel. This presentation will be there. And so, again, Katerina, Rafael, thank you so much for your time. Eric, do you have any closing words?
No, just thank you to CoStar, Katerina, and Rafael. That was a great job. Again, we appreciate it.
All right, everyone. Thank you so much for your time, and we'll see everybody next month. Thank you so much, and Happy New Year also.
Thanks, everyone.
Thank you, everyone.
Thank you.
Bye now.